Welcome to The Explainer. Man, am I incredibly excited to have you here today. We are going to dive straight into this because we're unpacking some truly fascinating strategies from Franklin Ochoa Jr.'s brilliant book, Secrets of a Pivot Boss. We're breaking down one of the absolute most powerful setups in his entire methodology, the Camarilla breakaway play. Seriously, if you're the kind of person who loves structure, if you love seeing exactly how the math of the market translates into massive opportunities, right there on your screen, you are going to absolutely love this.
So, you know that feeling, right? You watch the market close, you check your charts, and you realize you completely missed a massive, one-directional move. The market just takes off from the opening bell, never looks back, and you're just left sitting on the sidelines wondering how you could have possibly seen it coming. We call these trend days. They are incredibly explosive, and missing them, well, it's deeply frustrating. But what if I told you there's a highly systematic, measurable way to anticipate these days before they even happen? That is exactly what the Camarilla breakaway play is built to do. It's essentially your solution to catching those massive moves.
And there's this brilliant quote from the legendary Jesse Livermore in Chapter 8 of our source text that sets the stage for this perfectly. He said, "A man may know what to do and still lose money if he doesn't do it quickly enough." You see, knowing that a breakout might happen, that's really only half the battle. To actually capture a trend day, we have to transition from just looking at theory into executing a strict chronological playbook. Bottom line, we need rules.
And here is your playbook. We're going to break this down into 4 tactical phases. First up, prospecting with inside value. Second, evaluating the opening gap. Third, confirming the entry. And fourth, managing the trade.
All right, let's jump right into phase 1, prospecting with inside value. So this is where we do our homework. The beauty of this entire strategy is that the heavy lifting actually happens the day before you ever place a trade. The core of our prospecting relies on finding what Ochoa calls an inside value relationship. Now, this occurs specifically when the third layer of the Camarilla indicator, that's your H3 and L3 levels, for the current session, lies entirely within the third layer of the indicator from the prior session. Think of this relationship kind of like a tightly coiled spring. All of that market energy is compressing, winding up tighter and tighter, literally just waiting for a catalyst to snap and release all that stored energy into a massive breakout. Take a look at this chart here, because it brilliantly illustrates exactly what that coiled spring looks like. We're looking at a 15-minute chart of Energizer holdings. Notice that box on the right. Ochoa points out how using the DC3 indicator seamlessly alerts us to these extremely narrow developing Camarilla levels for the next day's trading. Because both lines of that developing indicator lay inside the static Camarilla indicator of the current day, it's screaming at us that an inside value relationship is locked in for tomorrow. Boom! We've successfully scouted a potential trend day. Okay, moving right along to phase 2, evaluating the opening gap. Now look at the tension being released here in this continuation the very next morning for Energizer holdings. After identifying our inside value relationship the day before, we are just waiting for a gap at the open. Right here, the stock opens with a massive bullish gap that occurs right above the prior day's price range and value, specifically above that critical H3 Camarilla level. This sudden gap against the prior day's super tight consolidation, that's the catalyst sparking our beautifully trending day.
But listen, here is the crucial point. Not all gaps are created equal. Ochoa outlines a very specific sweet spot for this play. You want the gap to occur beyond the third layer of the indicator, meaning past H3 or L3, so that it's actually large enough to trigger a genuine breakout. However, if the market gaps all the way beyond the 5th layer, like H5 or L5, it might actually be too big. A gap that massive is often way too difficult for the market to digest, which usually leads to a reversal or a bunch of chop rather than the sustained trend day we're looking for.
Which brings us to phase 3, confirming the entry.
So, we have our coiled spring, and we have our sweet spot opening gap. But let me be clear, seeing the gap is simply not enough. You can't just blindly throw money at the screen here. We need strict execution rules. Here is the exact chronological sequence of what you need to watch for in the first 5 to 15 minutes of the trading day before you commit a single cent of your capital. Step 1. The opening print confirms a breakout by gapping beyond the prior day's range. Step 2. You wait. You patiently allow price to pull back and test the closest Camarilla pivot that it just gapped over. And Step 3. You wait for a successful test, typically confirmed by a sharp intrabar wick reversal right at that pivot.
Check out how flawlessly these rules play out in real time on this 15-minute chart of the E-mini NASDAQ 100 futures contract.
The market opened the day but above the prior day's range and above the H4 Camarilla level. Now, did Ochoa buy the open? No way. He let the first 15-minute bar play out. Price pulled back to test that H4 level, touched it, and formed a beautiful bullish wick reversal. It was only after that confirmation that he entered the trade, right near the open of the following bar at exactly 1872.50.
And finally, we hit phase 4, managing the trade.
Once you are actually in the trade, all that excitement, it needs to fade into cold, hard logic. It requires immense patience and entirely emotionless execution. I really want you to burn this specific number into your memory. 1.5. This single number is the absolute secret to riding a massive trend day from the morning bell all the way to the afternoon close.
Let's walk through the exact trade management rules. As soon as you enter, you place a fixed loss stop safely below the low of the day. But here's where the magic happens. You manage your profits using a trailing stop with a 1.5 average true range, or ATR, cushion. So why 1.5? Well, because it's intentionally wide. On a day you suspect is going to be a trend day, you want a cushion wide enough that normal market noise isn't going to shake you out. Your goal is to hold on for as long as possible, ideally letting a mechanical trade session boundary stop automatically liquidate your position exactly 15 minutes before the market closes. Visually track that stepped line following the price upward on our NASDAQ chart. That right there is the mechanical 1.5 ATR trailing stop in action. Notice how, because of that intentionally wide 1.5 cushion, the stop was never once tested throughout the entire session. It kept Ochoa in the trade all day until his mechanical exit triggered 15 minutes before the close at 1887. That turned into a massive 14.5-point gain, netting $290 per contract, completely stress-free.
So, we've prospected the inside value, evaluated the gap, confirmed the entry, and mechanically managed to trade. But honestly, it all comes down to this final question. Do you actually have the patience to let the 1.5 ATR stop do the work on your next trend day? Knowing what to do is easy, right? Having the discipline to execute this playbook without letting your emotions get in the way, that is what makes a truly great trader. Thank you so much for joining me on this explainer, and I hope this helps you capture that next massive breakout.